Let's talk about Chapter 8. Chapter 8 is starting in your book on page 332 and 333. And you can see the topic here is completing the operating cycle of a business. Okay. So remember, the operating cycle is talking about the things that businesses do as they go about their day-to-day operations. Okay. What are the bills they're paying, the costs being incurred, what kind of transactions. We've covered a lot of them. We've talked about inventory already now. So the next thing is talk about payroll and employee compensation. Compensation above and beyond just payroll. Okay, so payroll is right away on page 332, and the point here is to recognize the payroll expense. Also keep in mind that businesses are really tax collectors also. There's a lot of payroll taxes and withholdings that the government is requiring anybody who has a payroll to hold from employees. So, next time you get your paycheck, take a look at it, right? Your gross pay is a very large number, or whatever that number is, and subtracted from that is withholdings. Okay, because you are an employee, because you are a person who's alive and breathing, you are taxed, and so you're paying FICA tax, federal income tax. Those are being withheld from your paycheck. Your employer is taking those from you and then remitting those back to the government. Okay, and so those are not expenses to the company. The company is just basically a flow through collecting that tax and remitting it to the government. Okay, now on top of that, the company also does have to pay payroll tax. Okay, with FICA, there's two sides to it. FICA is paid half by the employee and half by the employer. So the employer is incurring a tax for FICA. The employer is also having to pay unemployment tax, plus any other taxes being assessed by the local government that the business is in, okay, that it has to pay. So there's a number of payroll journal entries that are incurred or that have to happen because of the withholding and the payroll taxes. Okay, so look at this top entry and imagine that's your paycheck. Okay, let's say your paycheck was $2,700 for a pay period or for a month or whatever it is, and then we know we're not taking that much home, right? We know that what's going to happen is that our employer is going to withhold taxes from us. So in this example, what's being withheld is FICA taxes, federal income tax, and state income tax. And so that $1,723 credit to salary payable, which could have been a credit to cash, it would have worked the same way, is the net pay. Okay, so if that was my paycheck, my gross pay was $2,700, my net pay was $1,723. And then the employer also incurs payroll tax. With FICA, it's half paid for by the employee, half paid for by the employer. So the employee has 180 withheld from the paycheck. The employer also has to pay an additional 180, which is the credit to 180 down here. Okay. The employer also pays unemployment tax. Employees don't pay unemployment tax, only employers do. So now the employer is paying unemployment taxes for the 30 and the 68 right here. And then debiting expense for the employer's recognition of payroll expenses. Okay, so two journal entries regarding payroll that are done by employers whenever a payroll happens. Well, many employees are paid more than just a paycheck. Some employees get bonuses. Compensated absences, you're basically paid to not be at work, like through a vacation or a paid time off policy that an employer has. And so bonuses are recorded just like payroll, going to be the same journal entry we just got done looking at. Some businesses pay bonuses at different pay periods than your normal paychecks. I worked for a business where you were paid on the 15th and the 31st of every month. And then once you were paid a bonus, they paid it in between one of those dates. So you had a separate check specifically related to getting your bonus for the year. But it's just the same type of journal entries would happen. Compensated absences then, you kind of incur those throughout the year. It doesn't change your paycheck from the employee side. You're basically getting paid to not be at work. But then you might have a bank of paid time off that you tap into. And if you go above that time, then you might just not get paid for a day that you're gone. Some other benefits, some other compensation that some employers have. Stock options, post-employment benefits. Stock options giving an employee the right to buy stock more or less at a bargain, and using stock options as compensation to help attract employees, reward employees. And this would only be for companies that have stock available. A privately held company would not have this ability to offer stock options, obviously. I should back up the train just for 1 second when it comes to the compensated absences. I want you to be sure to take a look at page 334, and they will show some journal entries that a business has to make when it comes to accounting for sick days and compensated absences, because that's a liability. I mean, basically for the employer, any banks of time that employees have available to use would be a liability for the employer, and they have to make sure that they account for that accurately and correctly, obviously. So there's some journal entries that I want you to take a look at on page 334, which are also right here, the same entries. So the same concept of those entries regarding sick days and some salaries payable around sick days. The bottom entry, you can see we might have to accrue for a bonus, and in fact most businesses do that. If they know that they're going to pay a bonus once a year, they just accrue for that every month of the accounting year, and set aside, recognize a portion of the expense regularly, as opposed to just once per year, and set aside a liability to record that estimated future bonus. There's also post-employment benefits available to some employees, pensions, severance benefits, and those also have to be estimated and accrued for in the period that an employee is terminated. So if an employee leaves and there's some kind of an obligation owed to that employee in the future, the employer has to make sure to account for that. Next is pensions. Pensions are discussed on page 336 and also on 337, and some terminology surrounding pensions. We've got a defined contribution pension or defined benefit pension. A defined contribution pension is where the employer is contributing a specific amount basically every year or with every paycheck to the employee, to be paid back to that employee then after retirement. So your employer is putting money aside annually or with every paycheck. That's a defined amount. If it's probably a percent of your earnings for the year. Quite often with a union where there's a pension, it's probably been negotiated what that will be. Okay. And so after retirement then the employee receives that contribution plus earnings on that contribution that's been accumulating over the years. Okay, and the employee is then bearing the risk of poor returns on that. Defined benefit then is the employee is receiving a defined amount of benefit that's defined in the retirement plan, and typically based on years worked, and the company is setting money aside to cover that obligation, and the company is bearing the risk of poor returns on that money that's being set aside. Okay, so basically the employer is saying, if you work for me for 30 years, you'll get X dollars per month when you retire, and that amount that you'll get per month is defined based on how many years of service you've accrued. Okay, and the employer is putting the money aside and bearing the risk of the investment. Defined contribution is more like a 401k where you might be putting some money aside, the employer will match that up to a certain point, and then you are deciding where that money is invested, and you are bearing the risk of poor returns. Okay, so a pension fund is that money set aside. A pension benefit obligation is the liability that the employer is setting up, which is an estimate of future pension payments. Pension-related interest cost is the increase in the pension obligation resulting from interest earned on the unpaid obligation. A service cost then is the increase in the pension obligation resulting from employees working more. So every year of service increases the more pension that will be owed to that employee. And the return on pension funds then is what the company is earning by investing pension funds. Okay, so pension liability is made up of the pension benefit obligation minus assets that are set aside to fund the future benefits. The difference is a liability. And then pension expense is made up of interest cost, service cost, minus the expected return on those fund assets, so minus any return on investment. Okay, and when it comes to pension accounting and things that you'll be quizzed on or tested on, is primarily going to be the terminology. Okay, so really focus on understanding what that terminology means. You know, the quizzes that you take are not timed, so you can look them up. The test is timed. You wouldn't have as much time to look them up, but just have a good idea of what the terminology is before you take a quiz or a test associated with this chapter regarding pensions. Okay, next is taxes. Sales tax, for example. In South Dakota, sales tax is a big deal. It's probably one of the biggest sources of revenue for our state, for our city. So we all know that if we go and buy something, we pay a sales tax. The business does not keep it. The business is, again, collecting. So businesses do a lot of collecting of taxes and then remit those taxes to different taxing authorities. Okay, so payroll taxes primarily go to a federal government. Unemployment taxes both go to federal and state governments. Sales taxes in South Dakota would go primarily to the state and a little bit to the cities. Not all cities charge sales tax, most do. But sales taxes are going to go to your state and your city. So we all know that as customers, if we buy something, we pay sales tax. The employer then is holding on to that tax and then remitting it to a business. Okay. So for this example, we got a barbecue joint. They sold 100 sandwiches. They collected $340 of sales revenue in those sandwiches. So they can credit revenue for $340, but they also charge 5% sales tax. And so when they charge a customer $3.40 for a sandwich, they're adding 5% to that for sales tax. So they're collecting more than $340 with the extra $17, which is 5% of the $34, then being a liability that will then have to be remitted to local government. The way it works in South Dakota is businesses file a sales tax return, and they have to file it. Like a big business would do it weekly. A small business might just only do it quarterly, and then you remit that to the state. And so all the sales tax goes to the state of South Dakota. The state then remits the city's portions back to the cities. So, here in Sioux Falls, most things will pay a 6% tax. The business sends that 6% to Pierre. Pierre keeps 4%, sends 2% back to Sioux Falls. That's the way it works. Okay. Property tax assessed by the county based on your property value. A portion of that property tax then goes to the county. A portion goes to the city. A portion goes to a school district. And so your property tax is really made up of three things for the most part. Part of it's county, part city, part school district. And so you can see here this barbecue joint is going to get assessed some property tax. And in this example, they've already set up a prepay. Usually the way with property tax is you're paying in advance for a year. And so they're going to debit the expense and credit a prepaid. This is basically incurring the expense after the prepaid's been set up. And they got some more property tax examples are on page 340 if you want to take a look at those. And then the accounting for income tax. So here we're thinking federal income tax, just so you're aware of it. Now, the key thing with income tax is income taxes are based on income and may be different from actual taxes paid. Okay, and so it says here that Bonds Barbecue had a pre-tax income of $385. Its income tax rate for the year for both federal and states 30%. It says prepare an adjusting entry at year end showing the company's tax expense. Okay, and so you can see what they did here is they took 30% of 385 and were debiting income tax expense and crediting income tax payable, which is $115,500. Okay, so now a key thing with federal income tax though is that GAAP accounting rules are different than IRS accounting rules. Okay, and so most businesses will have a different taxable income based on GAAP than they would for tax. And there's a number of reasons for that we'll go through in the future. But just know that there are differences because the tax code is set up to basically enhance the government's ability to collect tax, whereas the GAAP accounting rules have been created to basically give a good and accurate measurement of net income based on matching revenues earned to expenses incurred in the same accounting period. So they each have a different goal, and so because of that, you have the concept of deferred taxes. Okay, so in this example, it says that Bonds Barbecue owes $80,000 in taxes on its income, but it also has gains on a mutual fund that will not be taxed until the mutual fund is sold. Keep in mind that the tax code is really based more on cash, when cash has been received or when cash has been paid, whereas GAAP accounting we know is not based on cash. It's based on the accrual method. Okay, so that's a key difference between the two. And so in this example, there's a $40,000 difference between GAAP income and tax income. And so our income tax expense for GAAP is $120, but we actually only owe the IRS $80,000. Okay, and so the difference is a deferred tax liability based on this unrealized gain we have on a mutual fund. Okay, so just know the differences are based on tax being more on cash, GAAP being on the accrual basis. The next thing we can talk about is contingencies, contingent liabilities. These are mostly on page 345 and 346. A contingent liability is only a liability if some future event happens. Okay, it's dependent on some future event to determine if a liability really truly exists. Okay, environmental liabilities are liabilities that definitely exist, but measurement might be difficult. It might be very difficult to establish the amount of that liability. Obviously, the oil spill in the Gulf, we all knew that somebody's going to be paying for that. It doesn't matter who will be paying for it. And they give the example of the book of an oil spill for ExxonMobil, a disclosure made back in 1991 versus a disclosure made in 2008. Okay, and so it's worth looking at both those disclosures. And those are disclosures that will show up in the notes to the financial statements. And so the key part of that there is the extensive note disclosure so that users of the financial statements will have at least an understanding of what these contingencies are, how much has been recognized versus what might need to be recognized in the financial statements. And so when it comes to contingent liabilities, we've got basically three different levels. Probable means it's probably going to occur, and so we will definitely estimate that and make a journal entry, and of course provide some note disclosures. Reasonably possible, the chance of the future event occurring is more than remote but less than likely. At that point we would probably not book anything. We would just disclose it. We would definitely write about it in the notes but not make a journal entry. Remote means the odds of something happening are really remote. We wouldn't even book it. We wouldn't even disclose it. Okay, so probable, reasonably possible, and remote are the three levels of liabilities. Next is, should we capitalize something or expense something? How do we decide how to approach or record certain kinds of expenses? This is on page 348 of your book. To capitalize something means we're going to debit asset. Okay, we get some expenditures occurred or happen, and instead of debiting expense, we'll debit asset. So we got kind of a spectrum or a range that they show us on the top of page 348, Exhibit 8.5. On the very left side, we have expense, things like using up office supplies. Then we get to repairs, research and development, and then to the furthest right side, land and equipment, which is asset. Keep in mind that R&D, research and development, are expenditures. As we incur R&D, we expense it. We do not capitalize R&D. The reason is the uncertainty of the future benefits of R&D. We can spend millions and hundreds of millions of dollars in R&D that never turns into a product that can be sold. Okay, and so because of that fact that the vast majority of R&D does not turn into a product that can be sold, we then will just be conservative and expense all R&D. Okay, advertising is the same way. It's really hard to measure sales to advertising. And so the conservative approach is to expense all advertising costs. So anything expended on advertising is immediately expensed because of the uncertainty of future benefits. If we're promoting our brand or our company image, there is definitely value to that, and we would hope that that would increase future sales. The hard part is measuring that. Okay. Now there's a small exception, and that comes if we're target marketing to previous customers, and we're doing some very specific, specialized target marketing to customers we've already got. We could potentially capitalize that. Okay, but general advertising, promoting our brand, promoting our products, it's really hard to measure future benefits. So to be conservative, we simply expense those types of expenditures. Let's go back and look at the income statement again. We all know that the income statement is revenues less expenses, right? And we get down to the bottom line, net income. However, there are some very specific items that come into play that we need to be aware of. And they show us an example of an income statement on page 351 of your book, page 351. And number one, let's keep in mind what gross margin is. Gross margin is net sales. And remember that net sales is sales revenue minus my contra sales, things like sales returns and allowances and sales discounts to get down to net sales. I subtract cost of goods sold, and that gives me gross margin, my gross profit. So sales minus net sales minus cost of goods sold is gross margin, okay, which is my markup. And then I have other revenues and other expenses, kind of items that happen, as they say in the book, peripheral to our normal operations. Okay, so if I have excess cash in my business and I choose to invest that by buying some stocks, bonds, mutual funds, I'm going to earn a return on that, some dividends and some interest. And that's not earnings from my operations. It's just kind of to the side of my operations. That's another revenue. Same with expenses. We can incur some expenses that are kind of outside the normal boundaries of just our core operations. So those are other items. We specify those separately from the rest of expenses and revenues. Then we have extraordinary items, things that are very unusual in nature and very infrequent in nature, but are very material. So they happen, they're unusually when they happen. They don't happen very often, but they're very big. Okay. So non-operating gains and losses. Report those items net of taxes. So things that we would incur, like a loss on a flood, loss on a fire, an earthquake, some natural disaster that's caused a very large loss. And we report that separately from the rest of our operations. And we report that number net of tax. Now, the reason we report that separately is comparability. Okay, most companies like to issue an income statement that might show at least 2 years, if not 3 years, compared to each other. Okay, if I have the ability to take this unusual, extraordinary item out of operations, report it separately, I now increase comparability year to year to year. Because if I included this extraordinary item within my normal operations, now I've got this blip in 1 year, and that takes away comparability. So the whole point is to increase comparability by separating out this extraordinary item. Okay, so the general format of an income statement, and again, take a look at the one that you'll see on page 351. Revenues less cost of goods sold to get to gross margin. And then we take our expenses and we report those in two different categories. We report them as selling expenses, also as general administrative expenses. So selling expenses are expenses incurred to the marketing and sale of our product. General administrative is everything else. That's our operating income, income earned by doing the core operations of our business. Then we have the other items that are small, like doing some investments and getting some revenues or some expenditures that are outside the expenditures of our operations, to get down to income before tax. Then we have income tax. Then we have the extraordinary items to get down to net income. The whole point is to have a good and comparable operating income number. And so I want to be able to look at that number year over year to see, am I earning more or less than previous years when it comes to my operations. Finally, let's talk about earnings per share, or EPS. This is in your book on page 352. It's income divided by shares outstanding. This only would apply to corporations. And the GAAP accounting rules require that corporations disclose an earnings per share number. And it's used by investors. They like to look at that earnings per share. It's basically, what is every share of stock? What earnings are associated with that share of stock? That doesn't mean we're going to get that earnings as a shareholder. It just means my share of stock represents some earnings of some amount. Okay, we like to show that number historically. Is it going up or down over time? And also we have what they call a diluted earnings per share. So what happens then is if we've done some stock transactions during the year, if we issued more shares of stock, if we've done a stock split, stock dividends, we're doing a weighted average of earnings per share, and so we can historically compare earnings per share from 1 year to the next. Because if I do some kind of a stock transaction, that affects my comparability. Okay, that ends Chapter 8. Again, as always, be sure to review some of the information that you'll see at the end of the chapter, pages 353, 354, 355. Review some of those key terms. Take a look at some of those review problems at the end, and just to help you make sure you understand the key concept of the chapter. Thank you.